Hi, this is Dean Smith for Insurance Options. During the last video we went through the fleet claims experience so we could see the format of the fleet. During this video we're going to try and run through the details of the fleet so you can understand in a little bit more detail how an underwriter may arrive at a premium. First of all, we're going to take a look at the inflation factors that fleet underwriters may look at. For the claims that are shown on a claims experience, they will be inflated. As time goes by, the cost of those claims historically will increase. So in this example, we're going to use figures of 21% for 3 years ago, 14% for 2 years ago, and 7% for the most recent year. The reason this increases so much is because of things like medical claims cost inflation. The cost to repair vehicles increases over time, so the figures are different to the retail price index. What the underwriter will also be looking at when they're trying to look for trends is to divide the cost by the number of vehicle years. This then gives them an accurate measure of what they call exposure. An underwriter, when they're looking at the claims experience, they're trying to identify trends. So what they'll do to do that is they'll break down the figures, and you'll see the effect here that adding inflation has to those figures historically. So you're already looking for a higher charge that they're basing it on today, rather than the traditional exposure that was there in the past. One of the first comparisons that they make is the claims cost per vehicle year. So they will divide the total cost by the number of vehicle years that are shown on the claims experience. The next comparison they'll make is the average cost per claim. They'll also look at the frequency. This is how many claims you're having compared to the vehicle years. A private car, for example, they may be looking for a frequency around about 30%, and it'll be different for each type of fleet. Okay, in this example what they'll do is they should deduct the cost of the excess. Okay, in this example what they'll do, the excess increased in the most recent year, so the underwriter should go back and deduct some of the amount in the previous 2 years. Say for example there were 6 claims, there's a calculation given there, so approximately it could be round about 1,500. The trend here has been for the claims to increase when you look at the claims cost per vehicle year. So because the claims experience, the trend has been for the cost to increase year on year, an optimistic underwriter may wish to take an average of all 3 years. That would bring the start point down. A more cautious underwriter may trend for the claims details for the most current 2 years. And then on top of that, they'll add an amount for catastrophe. That will be different depending on the makeup of your fleet. So if you've got mainly a fleet of cars or light vans, that will be less. If you're running a fleet of heavy goods vehicles, that could be considerably more. The potential to cause damage is significantly greater for larger vehicles. Each insurer will have a minimum amount that they will require for the type of vehicle. That's almost regardless of cost. So if your costs are higher than that minimum amount, that's when they look to charge more. They look to charge an amount for profit. This can vary from insurer to insurer. Typically it can be anything from 1 to 5%. They'll also look at some of the good features that they may wish to discount for, such as driver training that you've had, or decals that you may put on the vehicles, and handbooks that you may have introduced, or procedures following claims that you have to interview drivers. So here we can see fleet insurers for a private car fleet may look for a frequency as low as 30%. What an underwriter will actually do, they'll compare your fleet against how the rest of their fleets are running for that particular insurer and look for similar trends. The underwriter will look to see if your fleet is running better or worse. They'll also need to make an adjustment for the competition. If you've stayed with the same insurer, they may choose to cap the percentage increase. Conversely, an underwriter may not be willing to reduce the price if that fleet is already held by the insurer, so it can sometimes be worthwhile seeing how a different underwriter may react. Thank you. This is Dean Smith for Insurance Options.